Slide Limited is preparing a cash flow forecast for the 3 months period from January to end of March. So January, February and March. The following sales volume have been forecasted. So the sales volume have been given to us for the month of December, January, February, March and April. It is provided in terms of number of units. Per unit selling price is given. It is an amount of rupees 600. Sales are on 1 month credit. Means average collection period is provided to us as 1 month. Production of the goods for sale takes place 1 month before the sales. So the month in which we are going to sell it, before 1 month we are going to produce it. Each unit produced requires 2 units of raw material costing an amount of 150 rupees each. No raw material inventory is held. Raw material purchases are 1 month credit. Raw material purchases are on 1 month credit, means average payment period is 1 month. Variable overhead and the wages equal to 100 rupees per unit are incurred during production and paid in the month of production. So immediately it is paid, there is no outstanding. The opening cash balance on 1st of January is expected to be 35,000 rupees. A long-term loan of rupees 2 lakhs is expected to be received in the month of March. A machinery costing 3 lakhs will be purchased in the month of March. Prepare a simple cash budget for the month January, February, March and calculate the cash balance at the end of each month in the 3 months period. So on monthly basis we are required to prepare the cash budget from the given information. So once again a very simple information is given wherein the projected sales is given. Based on that, say we are going to calculate the production. Sales value can be calculated because the selling price is given to us. Based on like the production, we can compute the material cost, labor and overhead cost. So once again the first working note will be simple, wherein on monthly basis what are our expenses and what is our sales that we will compute, and then we'll prepare a simple working for the cash budget. Please go through the question, all of you. So write down answer of the question. Working note number 1. Calculation of sales and monthly expenses. Column number 1 will be month. Column number 2 will be sales in terms of number of units. Then we'll have the production again in terms of number of units. Then the sales in rupees term. Cost of direct material in rupees term. Direct wages and overhead, it is in rupees term. That is the way we are supposed to prepare. Again friends, as what we already have discussed, we'll prepare this working note exhaustively starting from December to April, even though we have to prepare the cash budget only for 3 months, January to March. So I request all of you to write down answer along with me. Column number 1, month. In that it is December, January, February, March and April. Again the sales units have been given to us. It is 1800, it is 1875, then it is 1950, then it is 2100, then it is 2250. I request all of you to fill up the production units column. So the question is providing the information that production of the goods takes place 1 month before the sales. So whatever the units that we are going to sell in the month of January, that we are going to produce in December. So we will be having say a kind of working like this. It is 1875. In the month of January, we are going to have the production equal to the sales of February, that is 1950. Then again, in the month of February, production will be 2100 number of units. Next, in the month of April, whatever the sales that we have, that we are going to produce in March, that is 2250. This is the way we will have the production on monthly basis. Now write down the sales value column and direct material cost column. You complete those two columns, then I will do working for you. Yeah, selling price is provided to us in amount of rupees 600. So what will happen, we understand that say, as far as the sales value is concerned, it is 600 is the sales value into 1875. That comes to 11,25,000. Next is 1950, 600 into 1950, 11,70,000. Then 600 into 2,100, 12,60,000. Next is again 600 into 2250. Oh, sorry. I written it wrongly. It is 1800 into 600 is the sales value. So it is 1800 into 600. That comes to 10,80,000. I'm sorry to all of you. Then 600 into 1875. 11,25,000. 600 into 1950. 11,70,000. 2100 into 600. 12,60,000. 2250 into 600. 13,50,000. That is the way we are required to compute the sales value on monthly basis. Next is the cost of the direct material. The question says that the cost is 150 rupees and each unit produced require 2 units of raw material. So we understand like this, that production is 1875 into 2, this is the number of units required for the raw material into 150. Then 1950 into 2 into 150. 2100 into 2 into 150. 2250 into 2 into 150. That is the way we will have the cost of the direct material. So it will be 1875 into 300, 5,62,500. 1950 into 300, 5,85,000. 2100 into 300, 6,30,000. 2250 into 300, 6,75,000. That is the way we'll have the cost of the direct material. Now wages and overhead, that is simply provided to us as 100 rupees per unit. So whatever is the output into 100, so the first case it will be 1875 into 100, 1,87,500. 1950 into 100, 1,95,000. 2100 into 100, 2,10,000. 2250 into 100, 2,25,000. That is the way we'll have the expenses on the monthly basis. Once we prepare this working note, then preparation of the cash budget is very simple. We are required to see that say how do we make the payment. The question is providing the information like this, that sales are on 1 month credit. So the sales of the December will be collected in January, sales of January will be collected in February, and so on. Then question is providing the information that variable overhead is paid in the same month, so there is no credit, it is paid in the same month. So expense of the January will be paid in January, expense of February will be paid in February, expense of March will be paid in March. Then information is given that raw material purchases are on 1 month credit. So whatever the purchase of December, that will be paid in January. Purchase of January will be paid in February, and so on. That is the way we are supposed to consider. Opening balance is given and certain miscellaneous adjustments have been given in terms of the loan and purchase of machinery. With that, so we will be able to prepare the simple cash budget. So let us start with the answer. Heading right down. Preparation of monthly cash budget, comma, from January to March. So we will have 3 columns: January, February, and March, apart from the particulars. So we start with the opening balance. Opening balance is provided to us as 35,000. So over here it is 35,000. Next is a collection of sales. Average collection period is provided to us as 1 month. So sales of December will be collected in January. What is the sales of December? 1080. Sales of January is 1125. Sales of February is 1170. That is the way we'll have the collection. So 10,80,000. Then it is 11,25,000. Then it is 11,70,000. It is the sales of December that is collected in January, sales of January which is collected in February, and sales of February is collected in March. And so on, we are required to prepare the cash budget. I request all of you to complete the remaining answer, then I will do answer for you. So next will be payment for purchase of raw material. Again it will be December, January and February, because the average payment period is again 1 month. So purchase of the direct material is 560 to 500, 5,85,000 and 6,30,000. So here It is 560 to 500. Next is 5 lakh 85,000. And the last is 6 lakh 30,000. Next, payment of this expenses, wherein it is provided that it is paid in the same month. So payment of expenses. In that there is no credit. January, February and March. What is the expense of January? It is an amount of 1,95,000. Expense of February is 2,10,000. Expense of March is 225. Okay. Then we have been given simple two adjustments. First is that we are going to take a loan of rupees 2 lakhs in the month of March, and we are going to buy machinery again in the month of March. So loan of 2 lakh rupees in the month of March and purchase of fixed asset, that is machinery in the month of March, rupees 3 lakhs. With that, so we'll have the closing balance. So please use your calculator. 45,000 plus 10 lakh 80,000 minus 560 to 500 minus 1 lakh 95,000. Closing balance is 357,500. Closing balance of January is opening of February. So plus 11 lakh 25,000 minus 5 lakh 85,000 minus 2 lakh 10,000. So it is 687,500. Now the closing of February is opening of March. 687,500 plus 11 lakh 70,000 minus 6 lakh 30,000 minus 2 lakh 25,000 plus 2 lakhs minus 3 lakhs, 9 lakh 2,500. This is the way simply we have to prepare the cash budget. B part of the question. Calculate the forecast current ratio at the end of the 3 months period. That is a question. Dear students, this question was asked in intermediate examination of November 2019 as question number 3, and it was carrying 10 marks weightage. So B part of the question says that you are required to make the computation of the current ratio. Let us understand how to make the calculation of the current ratio. Basically, current ratio is measuring the liquidity position of the company. So current ratio will be calculated as current assets upon current liabilities. That is what's the formula that we have. Current assets can be defined as that portion of the assets of the company that is converted into cash within 1 year, and current liabilities means that portion of the liability of the company which is again paid within 1 year of the operation. That is what we understand is the current liability. Current ratio is indicating that what is the amount of the current assets of the company for every 1 rupee of the current liability. So over here the current assets will be calculated as debtors plus stock of finished goods, because we do not keep the raw material stock, plus cash and bank. As far as the current liabilities is concerned, it is consisting of only one thing, that is creditors. This is the way we have the current ratio. Now, as far as the debtors is concerned, it's very simple. We understand that we have average collection period of 1 month. So in the month of March, whatever the sales that we have, this 12,60,000, it would be outstanding. So this 12,60,000 is considered to be the debtors. So over here it is 12,60,000 plus stock of finished goods. We understand that say whatever we are going to sell in the month of April, that we produce in the month of March. How many number of units? 2250. So the closing stock of the finished goods is 2250 into, this is in the units term. However, we have to compute the cost. 150 is the cost of raw material into 2. Why? Because the 1 unit of output requires 2 unit of input plus wages and overhead, that is an amount of 100 rupees. So basically 400 rupees is the cost of 1 unit, and we are having the stock of 2250 number of units plus cash and bank. It is an amount of 9,02,500 divided by current liabilities. That is also very simple. Since we have the average payment period of 1 month, so whatever we have purchased in the month of March, that is yet to be paid, and this purchase will be shown as outstanding creditors as on 31st of March, that is 6,75,000. So I request you to use a calculator along with me. 150 into 2, that comes to 300 plus 100, so this comes to 400. 400 into 2250, that comes to 9 lakhs. So this is an amount of 9 lakhs plus 9,02,500, and this is 12,60,000 whole divided by 6,75,000. Again, use your calculator. 12,60,000, that is the debtors. Sales of the March would be outstanding as on 31st of March plus 9 lakhs plus 902,500, so 30,62,500 divided by 6,75,000. That comes to 4.5370, or we can write 4.54, or we may mention 4.54 is to 1. That is the current ratio that we have. This is the way we are required to make the calculation of the current ratio as on 31st of March. Again, a small summary of the entire answer. We understand first of all that we are required to prepare a working note for calculating expenses and sales on the monthly basis. Information is given that the production takes place 1 month before the sales. Taking into account the payment information, we have calculated the receipt and payment, and then the closing balance is calculated. Then we are required to find the current ratio, that is a new point in this question, that is consisting of the current assets divided by current liabilities, that is the ratio, and accordingly the current ratio is found.